My name's Jennifer Schulp, and I'm the Director of Financial Regulation Studies at the Cato Institute in Washington, D.C. I am not an academic, although sometimes I play one on TV. I am a think tank scholar, and the Cato Institute is focused on the principles, ideas, and the moral case for liberty, which includes both economic liberty and personal liberties. And my focus is on free markets and liberty and spreading information about those topics to the world. At a think tank, rather than writing law review articles or, say, long papers, although occasionally I write books, my focus is on interacting directly with public policymakers. So I spend a lot of time talking to people in the administration, talking to people on Capitol Hill. My role is to interact with public policymakers. I talk to people in the legislature, I talk to people in the executive branch, and I do a lot of education around the ideas of free markets. And one of those roles is what I'm going to talk to you today, is about the role of the free market in financial markets. I'm going to start here. So, as I said, sometimes I write books. This is my book, Financing Opportunity. It's a book that we wrote about a year ago to talk about the importance of free financial markets and the ways in which free financial markets support prosperity and opportunity. Finance, as many of you in the room who study economics know, is basically the study of management of money and how it helps decide where money should be spent, saved, and invested in order to achieve desired outcomes. But financial markets are what make finance work. Financial markets allow people to allocate capital to its most productive use. And when I'm talking about financial markets, I'm not talking just about the stock market. I'm talking about bank loans, I'm talking about the interaction between people that help move money to the places that it needs to be used. Financial markets have a lot of different roles. They lead to price discovery. They tell us what something is at the center of where we want things to be bought and sold. Where can we agree that something is at the right price? Financial markets provide liquidity, so that investors who have put money into an investment can take that money out when they're ready to put it somewhere else or when they decide the investment is no longer meeting their roles. Financial markets help us to mitigate risks. I'm going to talk a lot today about risk and return and how those two things are highly related. And financial markets help us to mitigate risks while achieving the returns that we're interested in seeing. Financial markets reduce information monitoring transaction costs. They help us to be able to understand where the information is coming from and in order to make it easier to move money. Financial markets help us to smooth consumption so that if we want to take a loan today to buy something we need today, we can pay for it with tomorrow's money. And financial markets provide payment services, which allow us to make basically this entire system operate. Because if you can't pay for things, we can't move capital to its most productive uses. Financial markets, particularly modern financial markets, are incredibly complex. What I want to do here is just kind of overview very briefly some of the players in modern financial markets. There's individuals, investors, those who want to take out loans, those who want to put capital to use, and those who want to receive capital. Businesses fall into the same category. And then we have all of the people that we think about who are players in financial markets. Banks, brokers, investment advisors, insurance companies, investment companies. We're going to talk about all of these folks as we kind of move through this idea of financial markets as an engine for opportunity and as an engine for growth and prosperity. Particularly in terms of when we think about financial markets, we think that often a lot of these types of businesses get a bad rap. When we think about finance, these are the types of businesses, now I have no amplification. These are the type of businesses that often are painted with a broad brush and said that they're kind of the bad guys in the situation. And when finance is looked down upon, you hear about banks being the bad guys or brokers being the bad guys. The stock market is the bad guys. And we're going to talk today about how that is too simplistic of a view when we're thinking about the importance of financial markets. So, one of the reasons that we wrote the book is because for many years, and when I say many years, I mean thousands of years, finance has gotten a bad rap. In the United States, we talk about Wall Street. We talk about Wall Street versus Main Street. The people on Main Street are the average people running the economy, where Wall Street are the big fat cats who sit in New York City and who take money from the average part of the economy. The modern criticisms of finance that we hear kind of across the political spectrum is that finance implies excessive speculation. So when we think about the stock market, we think about prices going up, people investing to make money and looking to make a lot of money, and maybe the prices keep going up. Excessive speculation. But we need to realize is that speculation is not the right word to focus on here. Oh, and I have it back again. Speculation and investment go hand in hand. The purpose of finance is in order to move capital to more productive uses. The way that people are compensated for more productive uses is by making money and making the return for taking the risk to move things to more productive uses. Investment is the term that we use when we're talking about finance in a positive light. Investment implies that we are using money for productive use. You are taking money to invest it and to build someone's business. You are putting money behind farm equipment that is going to help us to grow crops. Speculation is what we view as the opposite of that. But connotations about both of these things aside, these terms are inseparable, because you cannot have investment for productive use without taking some sort of speculative risk. And that is an important piece of what I'd like to leave you with today. Speculation is not a dirty word, and investment is a term that we cannot just rely on to say that things are just good. So let's take a step back here. I started talking about the modern criticisms of finance, where we think about Wall Street being bad and Main Street being good. But these are not new criticisms, and finance has had these criticisms for thousands of years. The idea of using money to make money has been criticized as early back as the ancient Babylonians. There have been general prohibitions on the idea of interest from lending, starting in ancient Greece and the medieval Catholic Church. Judaism and Islam continue to prohibit making interest on lending to various degrees. In some ways, these general prohibitions on interest from lending, so using money to make money, made some sense in the ancient world. You could go to jail if you didn't pay back your debts. And debts and lending have often been used as political tools over the course of history as a way to have elites, Roman emperors and others, clear people's debts and make the people love them once again. So it makes sense in order to prohibit some sort of interest from lending, to stop people from being tricked into taking more money out than they can afford to pay back. But over time, this type of interest prohibitions and the lack of interest on lending hurt the ability of people to put capital to its most productive uses. The complaints about finance, once interest has been allowed, whether interest was allowed or not, continue. And it makes, again, sense, because when people lose money, they tend to look for someone to blame. And it's easy to find the blame in those who made the loans in the first place. This has been a recurring debate, even in the United States, since the time of the US founding fathers. Many viewed finance as simply as speculation and middlemen who were using money to make money and to do nothing productive in society, whereas others saw it as a vital tool for economic growth. But these criticisms miss the mark consistently. Wall Street and Main Street are inseparable, and finance plays an important role in being able to move money to its most productive uses. And when I've said productive, what's important to look at here is that it's not possible to determine the most productive amount of investment. So looking to limit finance and limiting the level of finance in an economy, in order to find the right limit, you have to know the right amount of productivity. That doesn't work without a financial market, and it's not an efficient way to make a market operate. It's not an efficient way to run an economy. In these circumstances, you need to be able to know exactly how many tractors you need to have in order to feed the country. What if the country grows? Was that the right number of tractors? The market is what allows us to make the decisions about the productive uses, and without the market, it's not possible to know ex ante what a productive use is. Finance also, the criticisms of finance here also fail, because it's easy for people to say that there are a lot of financial products that don't actually result in any sort of productive use, like derivatives, futures contracts, options contracts, insurance contracts. But all of those things have direct application to what we think of as the real economy. When we think about derivatives contracts, airlines, for example, use derivatives contracts to purchase fuel. Knowing how much their fuel is going to cost in the future allows them to operate today. Limiting these types of financial market activities limit the ability of the, quote, real economy to function. Moreover, finance, in this general concept of allowing capital to move to its most productive uses, allows people to be able to better their own lives and to better the lives of the society in which they live. It has the potential to lift people out of poverty. It allows them to innovate. It allows them to better their state of living, and it allows them to challenge institutions. None of these things are possible without the free flow of capital throughout an economy that is facilitated by a free market for financial products. That's not to say that there's a guarantee that every single person is going to make a winning investment. That's absolutely not true. I'm talking about this in the aggregate, and it's what allows people to, on the whole, move capital to where it needs to go to make these changes happen. What's important to note is that risk and return go together. A lot of finance regulation looks towards trying to limit risk, trying to protect people from decisions, trying to protect people from losing money. But risk is necessary in order for there to be a return on an investment. If you eliminate risk, you eliminate the upside as well, and there's no possibility of people being able to make more money, being able to put capital to those uses that allow us to innovate, that allow our societies to grow. So I previewed a little bit about finance and its regulation. Exceedingly complicated area, and it varies a lot by country. For example, let's take the United States versus Europe. Equity markets play a much larger role in the United States than they do in Europe, where corporate bonds are bigger in the United States as part of these markets. And bank loans in Europe are much more useful in securing funding for companies. There's a lot of history here. Banking was dominated in Europe by a number of giant firms, and the US has a fragmented banking system with a lot of small banks. Because of this, the United States, the small banks stayed local. They tended to make smaller loans, and because big companies couldn't go to small banks for big loans, bigger companies in the US turned to securities markets instead. The United States markets look a lot different than other countries' markets, and our culture of entrepreneurship in the United States meant that this kind of market-based securities financing gave people faster and easier access to capital and spread risk across many different investors. This decentralized finance in the US looks pretty different than a lot of the other financial systems across the world. But this allowed many US companies, particularly in the 19th century, railroads, steel, and other types of industry, to scale quickly, and in order allowed the United States' prosperity to grow in that sense. After World War II, when the United States kind of emerged as a financial superpower, other parts of the world moved towards copying the US financial system, focusing more on the financial and equity markets. Innovations like venture capital, securitization, and derivatives often started in the US and spread globally. This US system, our regulatory system, however, is not necessarily the global standard. And no other country has really copied our unique mix of decentralization and broad participation. All of that said, there are kind of similar themes across how financial institutions are regulated across the world. We take a look at banks. Banks are generally regulated by what's known as prudential regulation, which is designed to ensure safety, soundness, and stability, making sure that banks don't fail and making sure that the deposits in the banks are there when people want access to them. Markets, securities markets, derivatives markets tend to be regulated in a different way because we're not talking about deposits. Regulation for markets tends to be aimed at efficiency and fair operation of those markets so that the participants in the markets can feel secure in the transactions that are being made in the market. And there are rules that cover banks and markets regulators that are focused on kind of consumer protection, which protects individuals from fraud, and other consumer protection rules which protect consumers from risk or making bad choices. That was the lay of the land of how finance is regulated today. And in many ways, particularly in the United States, we have a relatively free financial market system compared to some other parts of the world. But financial regulation in the United States even remains heavily regulated. How should financial markets be regulated? The good, we should be protecting individuals from fraud. and from kind of misconduct in the markets that goes towards lying and goes towards falsehoods. This allows market pricing to function properly and protects the individual property rights of the people who are engaging in the market transactions. But what we should not be focused on in order to have financial markets that meet all of the goals that I set out at the beginning, that provide liquidity, that provide good pricing, we should not be focused on protecting individuals from risk. Risk and return are related. You cannot remove one without removing the other. Central planning, which is what happens when you are telling people that they cannot make a choice, they cannot put their money towards a particular outcome, towards a particular project, because their money should be going towards another project, is inefficient, and it can be misinformed. Again, as I gave this example before, how do you know the right number of tractors that an economy needs? How do you know what the economy will need 5 or 10 years from now if you are stepping forward and prohibiting individuals from making choices that will allow us to see that future? And protecting individuals from risk limits innovation. Many of the most risky investments are those that have led to some of the biggest innovations. A common example of this is kind of some regulation in the United States around stock offerings. So way back in the 1980s, when Apple was just starting out, Apple was trying to sell stock to the public. And in the United States, certain states have rules that say that you cannot sell a security in the state if it is too risky. And the state of Massachusetts prohibited shares of Apple from being sold in Massachusetts to Massachusetts residents. Well, had a Massachusetts resident bought Apple back in 1980 something, they would have made an awful lot of money. Because the innovations that Apple was putting forward, while risky, ended up being winners. It's kind of the telling story about this, that when we look towards what's known as merit regulation, the regulation that tries to make a guess about whether or not a security is a good investment, whether or not an innovation is a good innovation, whether or not it will be successful, government regulators are not very good at that. Rather, the wisdom of the market is what allows these things to succeed or fail on their own merits, and prohibiting people from making those choices about what to invest with their money limits the ability of innovative companies like Apple and others to be able to meet their full potential and to be able to add to a country's prosperity and add to a country's standard of living. Now, this is way more text than anyone should ever put on a PowerPoint slide, but it essentially sums up what the core principles for regulating financial markets should be. The short and simple answer to all of this is the government should be hands-off in terms of financial markets, because government interference hurts the ability of a country's economy to grow and the ability of people to make decisions about what they want to do with their own money to support the types of companies and the types of investments that they believe have a future. I'll highlight a couple of these. So we already talked about the essentialness of competitive financial markets. Market discipline is a better regulator of financial risk than government regulation. That is a principle that we have not talked about too much because I've been talking about some securities. But yesterday there was a question about the 2008 financial crisis. Rather than the government regulating, companies, financial firms should be allowed to fail when they make poor decisions about managing their own risk or about what the market is going to support. Government regulation has done a terrible job over the course of centuries in preventing financial crises. We're often heard to talk about today financial stability regulation is kind of a hot topic, particularly coming out of 2008 and the global financial crisis. Governments are very interested in trying to figure out how we prevent crises from happening again. The United States has heavily regulated markets. We have had more banking crises in the United States than anywhere else in the world over the course of the past 200 years. Government regulation cannot prevent financial crises. Financial crises can be mitigated by allowing the free market to function, because you have more diversity in the financial tools that are being used when people are not being told exactly how they need to plan their financial lives, as well as market discipline, allowing companies to fail, allowing financial firms to fail, will force people in these financial firms to take a closer look at the risks that they are carrying and determine if they're worth the rewards. Yeah.
Smart decision, handled well.
Well, the FDIC didn't save Silicon Valley Bank.
They insured the deposits over $250,000, right?
Yeah, they did insure deposits over $250,000. Financial deposit insurance is something that we've kind of accepted as a given at this point, but I don't think it should be accepted as a given. Financial deposit insurance, particularly when it's government-backed, has kind of led to this idea that you will be saved. Most of the depositors in Silicon Valley Bank had well over $250,000 in their accounts. And again, the government stepped in with a guarantee. These guarantees are problematic because they lead people to not judge their own risk properly. I commonly get a question in response to that, which is what would happen if there was no deposit insurance? Wouldn't anyone not put their money in banks because they're worried about not having access to it? The government stepping in here with government deposit insurance has crowded out what could have been a private insurance market on these fronts. And in fact, there are private insurance solutions for accounts over $250,000. So there are free market solutions to this that work better, I think, than the government guarantee here that creates moral hazards, where everyone now expects that the government will step in to save you. Yeah?
Sometimes when sickness comes, it is natural for someone to die, which is sad. But what we do, we try to mitigate the extremes all the time. We try to soften the blows and to maybe a little bit soften the highs also, to make things flow in some kind of more regular and predictable rate. So why is that not a sound policy to supply some cushions in case of downward spirals? We can't suffer the full brunt, but why should we do that? It will lead to much more suffering. Like, I can't let someone be sick and beat it on his own, but I can just use a little antibiotics and help him go through it. And also maybe when the markets are too high, we can save up for a rainy day. So why not do this stabilizing effect?
Yeah, I think that's a fair question. And I'll start by saying I don't think that we should function in a world where there's absolutely no regulation over markets. We should be prohibiting people from engaging in dishonest behavior. We should be prohibiting fraud. So there are places where even kind of in this free market world, there is a place for some level of regulation. Where you're talking about kind of easing the blows and kind of smoothing things out, I don't think it's as easy in the markets as it is in medicine to make the decision about what is going to be helpful and what is going to be harmful. And that is the problem with kind of the interference in the markets. When the markets are high, how do you define what is too high? We hear a lot about the 1929 stock market crash that set off the Great Depression. There was too much speculation in the markets. What does that mean? And that is something that we've taken a look at. The literature on that has largely all been post hoc as a justification and a rationalization that the speculation was too much. No one, I don't think that that's the right way to look at it, but no one was calling for that prior to 1929, saying that there was too much speculation in the market. And in fact, some of the people who have said there was too much speculation in the market, like John Maynard Keynes, were themselves heavily involved in the market, speculating, such as it is, and felt that he should be allowed to speculate in the market, just not other people. So the lines that we have to draw when we're talking about smoothing out the financial market system are just too difficult for them to be drawn in any sort of an efficient way. The only efficient mechanism for dealing with that discipline is the market itself. I saw a question over here.
Hi. You brought the example of Apple in Massachusetts that they were not able to sell it to the citizens. But isn't that a way of the government to protect its citizens from fraud? Because now Apple is Apple. We discovered it after 10, 15, 20 years. But there are so many companies that sell their stocks, and they try to sell their stocks, and yet they have zero value in the long run. So where should the government draw the line of I'm getting involved, am I allowing to sell stocks to a company or not?
Yeah, so you brought up an important point, which is protecting the people from fraud. There was no allegation for Apple, and there's no allegation for a lot of companies that there is actually fraudulent behavior happening. There's no one lying, there's no one cooking the books, there's no one doing something that is dishonest. Rather, it's an honest businessman trying to make a business work. Small businesses fail. People have great ideas that turn out to be ideas that other people don't want to buy. And having the government step in to tell people that they can't give it a shot is a way to limit innovation and to prohibit people from being able to make progress. You have to take the chance in order to see if the chance is successful. If the government steps in and says no Apple, no small business, you stagnate. And you don't allow people, to be people, to live their dreams, to let themselves create, to let themselves be entrepreneurs. But you also don't allow that person to grow their own prosperity either. So while it's important to protect people from actually fraudulent behavior, and I wouldn't suggest that the government should say, no, go ahead and invest, we know this guy's lying. I would say that the limitations based on just the government doesn't think that's a good idea. Government thinks you shouldn't put your money into that because you have better things to do with your money. That is not a way to grow a prosperous society, and it's not a way to allow people to prosper themselves. Even if they're taking risks, it might ultimately turn out not to be successful. So, heading back here, I think we've basically covered here. I think the other important point that went along with market discipline is that government backing for financial activities leads to government bailouts. And I think we've seen that nowhere more clearly than in the SVB solution, where 2008 happened. In the United States, we passed the Dodd-Frank Financial Acts, which were supposed to make it so that we never bailed anyone out again. And my understanding is that the US government walked around the world telling everyone that we will never bail anyone out again. Never. There was a lot of finger wagging at the European Union, apparently, about how no one was ever supposed to bail anyone out again. And then SVB happened. This is a vicious, dangerous cycle that leads to more and more government involvement in the financial markets, but also leads to less and less responsible risk-taking and less management by the players in the financial markets of their own risks that distorts the entire market process. Yeah. Yeah, so simple rules are preferable because they allow market participants to know what the rules are. Complex rules suffer from a couple of problems. One is the one that I state there, that they permit regulators to micromanage markets. Again, you have the government stepping in and saying, you can make this decision, you can't make that decision, all of which interferes with the efficient flow of information in a market and the efficient movement of capital. But complex rules also lead to situations where you have more and more entrenched interests in the rules themselves. So you are a stock trader, stock trading firm, and the rules tell you exactly how you are allowed to move a trade through the market. If those rules are really complicated, the chances that you win by something small happening your way are very high. And your interest in making sure that the rules work exactly your way is much higher. There is a much larger incentive for interference by players in the market to manipulate the rules or to manipulate the regulators in their favor. And these incentive structures are problematic. Simple rules largely avoid that. More people are treated more similarly. It is much easier to tell off the bat when you enter the market the way you are supposed to behave. And if your behavior is constrained in the same way as other people's behavior, it makes things function better. Yeah.
Your content on people making people think about their investments and making a good decision for themselves. You spread their investment in something. Does a free market have an answer for the risk option risk for people making bad decisions and losing their pensions? Like, is there something that the free market has given them for not making those bad decisions without regulations?
Yeah, I get that question a lot, and I think I'm probably going to give you an unsatisfying answer to that, because it largely rests on people having responsibility within their own space, and the government not being able to know off the bat what the right decision for individuals are. That does not mean that people will not make bad decisions, but the definition of bad is difficult to come by. You lose your money, but sometimes you lose your money if you made a good decision. You invested in your family's restaurant, and despite everything you knew about the restaurant, everything you knew about the business, COVID happened, and you lost your money. It wasn't a bad decision to invest in the restaurant, you just couldn't see the future. It is a question where we take this from there when we start talking about kind of social safety net, which we talked a little bit about yesterday. There may very well be a proper role for the government to step in if people are hurting and not able to meet basic needs. But that shouldn't up front cut off the ability of people to make decisions about how to invest ex ante.
Just wondering, you said that when the government gets involved and then it just skews everything and makes it worse. Thinking back at the 2008 financial crisis, you really see that the incentives were really misaligned, and that looking back, nobody was prosecuted for anything. And so I feel like free market works when everybody knows the rules and everybody works in their best interest. But you know that if you work hard and you can succeed and you make a lot of money, but if you do something illegal, you'll go to jail. But then you see that regulators have sometimes a revolving door where they get into the banks or vice versa, and then there's no threat of anything happening to them. In the 2010s, the banks had dark pools and they sold out their customers to algo trading firms, and they got maybe like small fines. And so there's no real threat of any prosecution to the banks, and so they're letting human emotions and greed. Things are getting screwed up because there isn't real threat of any prosecution. And so I think there is a place for some regulation in these cases.
Yeah, so there is a place for some regulation, but I think the 2008 narrative is wrong. The narrative that we hear about there should have been prosecutions. What laws do you think were broken?
First of all, I think the rating agencies gave AAA ratings to things that shouldn't have AAA ratings, right? These subprime mortgages. That's the first thing. And who's checking what the rating agencies do? That's the first thing. Second thing is, if the United States, if Ben Bernanke goes to the White House and asks for a bailout, and the U.S. taxpayer bails out these big banks, I don't think that Nick Fall, Jamie Dimon, and all that, you should get crazy bonuses.
Oh,
it makes no sense.
If the U.S. government bails you out, I agree, you shouldn't be getting crazy bonuses, but that is not a violation of the law. I know you were super interested in the 2008 stuff, so I'm going to give you this. I'm going to talk about this a little bit more fully, but you've asked a lot of questions on 2008, and we talk a little bit in more detail there about how the narrative about 2008 is kind of not correct. This risk-taking by the banks was well known by the government while it was happening, and banks made decisions about risk that were poor ones. They should not have been bailed out. But it wasn't a question of kind of deregulation. It wasn't really a question of illegality. This was bad decision-making, and they should have felt the consequences for it. I agree that where there are illegal activities happening, there needs to be an actual threat of prosecution. I just disagree that 2008 is an example of illegal activities happening.
This question, I'm wondering whether we can have sometimes situations where the country creates free market and free market is sort of a national economy in a way. A few years ago there was this pension reform in Israel that had many private pension companies compete to offer the pension that would be the default, like in certain terms that country had set, and now we have the default pension where it has very good conditions, and if you want, you can choose other companies, and prior to that, most people took the default pension that their workplace had, or that their first workplace at 60 had, and it was very bad one with very bad interest, but they never knew, and they knew they had no interest in changing.
Yeah, I think there are spaces where introducing competition into a system that doesn't have competition definitely helps. I need to know more about the exact structure of what they did to know if it meets kind of what I think of as a free market standard, but more competition is almost always better. It goes hand in hand though, and this was back to the question over here about how do you deal with people in the system that might not make good decisions. We need to create environments where people can get the educational resources that they need to be able to feel confident in that decision making. We have the same problem with pensions. We've moved towards, in our 401k system, which is the personal system for being able to invest your own pension money rather than having a pension. We have a default system now where you are automatically enrolled and automatically put into a certain fund. People need to understand what that fund is. It is good that they are invested, but it's not good if they don't understand what their own investments are. I saw one more question. Yeah. Oh, I can't. Sorry, I can't hear you at all.
Maybe it's quite of a basic question. Maybe you said it and I missed it. But when I think about financial market, I think about something like stocks, bonds, and stuff like that. And what does it mean, competitive financial markets?
Yeah, so it's stocks, bonds, but it's also bank loans, it's also insurance, it's also derivatives. Our financial markets encompass essentially all the ways in which money moves in the capital system. A competitive financial market means that there are not government regulations here that are limiting the number of people that can compete and the types of products that can be offered. Again, within the bounds of nothing fraudulent, nothing that's dishonest, but that allows for the creativity of the system to be able to make new products and allows people and entities to participate in those markets without kind of high barriers to entry. Okay, excellent. I love all the questions. Please keep them coming. I think I'm going to shift gears a little bit from this broader conversation to something that some of you might know a little bit about, being part of the Startup Nation. Has anyone here ever been involved with raising money for a company? Okay, so you're all going to be able to school me on some of this, particularly about how you do it in the Israeli system. But I want to talk about the importance of the free movement of money to startups and the development of their growth. Should be pretty obvious to most people. Startups are the lifeblood of an economy. Small businesses are the lifeblood of an economy. In the US, these are US numbers, but small businesses make up 99% of US firms. And they have contributed to over 79% of job growth since 2011. The vast majority of businesses start small and grow. And they're the incubators of innovation. Not just that they start small and grow, but it's where many of our great ideas start from a seed in someone's garage, in a WeWork, in a co-working space, in places that start with one individual who has an idea, who wants to grow a company. Without easy ways for these people to raise money to make their ideas a reality, we do not have the ability to move forward. We don't have the ability to grow an economy and allow people to better their own positions. Now, there's a lot of reasons that small businesses have a hard time getting started. Regulatory red tape is one. Unstable legal environments can be another. I've pointed this out. I've heard this woman speak before, and she talks about the difficult business environments in Africa. She's incredible. I would actually recommend looking her up because she talks a lot about the difficulties of starting a small business in a place that is hostile to business. And it's not simply that there's not as much money, but the problems of getting a business license, having a legal environment that allows you to protect your property rights, the importance of having everything together in order to support businesses. One of the difficulties with starting a small business that we're going to focus on today is the lack of access to startup capital, but I don't want to imply that having capital is all that you need to be able to have a business and to allow those businesses to grow. There's so much more here to having a startup business, to having a small business thrive, than simply having the money to have that business thrive. So how do you get the money to start a business? These are numbers from the US, but I think are relevant across the board. Most small businesses start with your own savings or with bank loans. They don't necessarily turn first off to outside investors. So the starting place for small businesses tends to start with the wealth of the business's founder, which makes it particularly important for us to think about how do small businesses start when the person with the idea doesn't have money. Because ideas can be good no matter where they come from. It doesn't have to come from someone with money. So how do we get the money to the idea? Small businesses that don't have the money have to turn to outside funds. This statistic here doesn't actually show the numbers I'm going to give now, but the same report that this came from when we turned to a small business that was looking for outside funding, 8% of those small businesses got a loan from their friends or family. Many of them got loans from banks, they got a credit line, they got a credit card, and 2% turned to the securities markets. These numbers are all from 2024. That number has varied some over time, but it always remains a pretty small percentage of the small businesses turning to the securities markets. But it's an important percentage. It's a way to get investment from a diverse group of people and to get investment from strangers. It's different from walking into a bank and meeting with the bank loan officer. This is a way to get support from the community and from a pool of investors. And even though it's a small percentage that seek out securities and equity financing, and we're still talking about massive amounts of money in the United States that are doing this. In 2024, over $1 trillion in securities was raised by small businesses. Over $1 trillion. So this gives you a little bit of the scope in the US, just how much money small businesses are seeking, that if this small percentage of small businesses that are seeking equity investment raised $1 trillion in 2024. Securities investment is a particularly important source of capital for small businesses that are technology dependent, who are very busy with research and development, or who otherwise don't have physical assets to put up as collateral for a bank loan. So this is very important if you are looking to build a small business that's in the high-tech sector. They're much more likely to turn to securities financing in order to get their business off the ground. So we're going to focus on this small securities section because it's the part that I know the best. And I think it's the part that's the most interesting part when we're talking about free financial markets and the decisions of people to make investment decisions. When we think about raising money, particularly if we haven't done it ourselves for a small business, most people's minds go to the stock market. Where are you going to get money? You're going to do an IPO. No, that's not where we start for small businesses. IPOs are very expensive, and they're good to raise large amounts of money in the public markets. But if you're just starting off, you have a small business, it is much more likely that where you're going to be looking to raise money is outside of the public markets in what we call in the US the private markets, but it's also kind of the less regulated space. It has different requirements. They're far cheaper to enter, and they're better for raising small amounts of money. So, let's say yes, we're going to talk about private markets. Making sure I'm giving you all of the information that I wanted to give you on this slide. Okay. What goes along with the private markets is a whole host of restrictions, because selling into the private markets is different from selling into the public markets. In the United States, as well as I believe in Israel, the default for doing a securities offering is doing a public offering. If you are selling securities, you need to do what's known as a public offering. That is very expensive, requires a lot of disclosure, typically requires some sort of proven track record. You can't do that when you're a small business just starting out. But the private markets are alternate paths of going there. But the way that you're allowed to participate in private markets is by meeting other requirements. And those requirements typically limit what you are allowed to do in terms of fundraising. And I'm going to talk through a number of those limitations, and I want to talk about the trade-offs here that come from those limitations. One of the first limitations when we're talking about raising money as a small business in a private market is you are usually limited in the type of investor that you are allowed to approach. This comes in a number of different types of limitations. One of them is that private market investing is only allowed to approach wealthy investors. So if you are a small business, you yourself have no money, if you want to raise money from other people by way of securities offerings, typically you will only be allowed to ask people to give you money who have a lot of money themselves. In the United States, that's known as the accredited investor standard, and it's limited to people being able to invest in these offerings who make over $200,000 a year, or who have more than $1 million in net worth. So the accredited investor standard, Israel has something similar. I'm going to talk about it a little bit later. Actually, the wealth thresholds in Israel are quite a bit higher, so you're even more limited in Israel as to who you can talk to get them to invest in your company. This standard has got an awful lot of trade-offs. It's put into place because these investments are less proven. They are viewed as more risky, so we want to make sure that the people who are going to invest in these types of investments know what they're doing. Private market investments don't give you the same level of disclosure about the investment as a public market investment does. They also are, by their very nature, more risky. These are smaller companies. They're just starting out. They don't have track records. So the wealth test is meant to ensure that the person that is investing is sophisticated. They understand the risks, they understand the financial future of a startup company, and it's also meant to ensure that they've got the money to lose, because we don't want people who don't have money to gamble taking this type of risk. That's a problem, and it's a problem on both ends of the spectrum, from both the investor side and from the small business side. On the investor side, this is telling people what they can and can't invest in. If I don't make enough money, I'm not allowed to invest in my neighbor's great idea. Doesn't make a lot of sense. I might know an awful lot about what my neighbor's trying to do. I might be a nurse and I don't make enough money, but there is a biotech startup that works in exactly the area that I do, and I understand that product inside and out, and I want to be able to invest. Wealth is a really poor proxy for whether or not you're sophisticated enough to be able to invest. And it's also a poor proxy for determining whether or not you have the money that you can lose. One of the problems with this wealth test in the United States is it makes the elderly with large pension savings targets for this type of investment. You're not necessarily more sophisticated because you spent a lifetime saving for retirement. Whereas, particularly when we're talking about small business investments, you might have a shorter time horizon if you're in retirement already, and small business investments might take an awfully long time to pay out. So it is a problem from the investor standpoint. But it's also a problem from the small business standpoint, because as I said, if you don't have money yourself, but you've got a great idea, the chances that you have lots of friends and connections that have lots of money are also pretty small. So you can't turn to your community, the people that know you best, that know your idea best, as a way of being able to raise money. You have to look further afield. Maybe you look to the coasts in the United States, Silicon Valley, that's where all the money is. But if you're from the middle of the country and you don't know anyone, your idea is probably not going to get off of the ground. It's also a major problem when we're talking in the United States about ethnic and minority groups who might themselves be generally disadvantaged when it comes to financial means themselves. This type of restriction hurts people from being able to get the money that they need to grow their businesses to better their own lot in life. And moving forward, there are other types of restrictions on the type of investor that can exist. Sometimes retail investors, meaning you and me, not being a business, are prohibited from investing in certain types of startup investments. Rather, those opportunities are reserved for those in institutions, big pension plans, investment funds, and others. Again, I think it's pretty easy to see there that that type of restriction has the potential to exacerbate wealth inequality and to exacerbate the ability of people to make their dreams come true in the startup space. Because again, if you're poor and have a good idea, it's going to be pretty hard to figure out how to get a massive pension fund to invest in your good idea, and much more difficult than trying to get family and friends to do so. There are also restrictions in this space on what we call general solicitation, which means a lot of times there are restrictions that prohibit small business owners from advertising for investment in their product or their company, because you don't want to accidentally advertise to someone that might not be wealthy enough to invest. So the types of limitations like this really, again, limit the ability of people to reach beyond their own networks to make investments. And if their networks aren't wealthy enough to make those investments, you've essentially shut off the ability of entrepreneurs to grow their companies. Similarly, there can be limitations on the amount invested. Just one second. So that people cannot make small investments because, again, they're looking for larger, wealthier people who are arguably more sophisticated to take these risks. Yeah.
I want to ask about what you said before about if you're poor but you have an idea, there's another option for you. Mm-hmm. And I want to ask you if isn't it a signal of a problem in the market? Because we want to say free markets, open opportunities for everyone, but if it blocks people if they don't have the right connection or enough money, so if we don't achieve our
Yeah, I think it's a problem, but I don't think it's a problem with the free market. The problem here is the restrictions that the government is putting on your ability to take advantage of the market in these circumstances. So in a freer market, a good idea should be able to reach the people that have the money. The government in these circumstances is saying you can't get the idea to those people because we're going to limit how you're able to interact with them.
Wait, but we talk about invest and get the money from the public, from the private sector. Mm-hmm. So how the government is doing it?
The government, yeah, what I'm talking about here are restrictions that the government has put on the entrepreneur's ability to interact with people who might have the funding. There are some other ways around this that I will get to. Crowdfunding is one of them. That has been something that's come into play to try to get around some of these restrictions. But here, if there were no restrictions saying that you have to only approach people that make X number of dollars a year, you would be able to raise smaller amounts of money from the people that you already do. The free market doesn't necessarily mean that you are automatically going to be able to advertise everything to the whole country, that you can necessarily reach every investor. But what happens here is the government regulation on those securities offerings prohibits you from even having the chance. Yeah.
I just want to ask, I'm actually in venture capital,
Mhm.
and I can tell you that around 99% of startups fail. Okay,
Yep.
and it might be the idea, it might be the execution, but most of them fail. And so,
Over what time frame?
all times of
I was just looking at the data on that, and according to what I just saw, 20% small business fail in the first year, 50% fail within 5 years.
I can tell you, at least in the high-tech sector in Israel, every guy can start a small startup in his bedroom or dorm room or whatever. In the end of the day, actual startups that are able to return equity to their investors, very, very limited amount. Okay, and so I feel that I know many stories of different people, of angels, of just private people who fell to many different types of frauds, and just in general, most ideas aren't that good enough to actually create a big sustainable business that can pay off its investors. And so I don't think that the average Joe should get into that type of risky investing, just as much as I don't think that person who doesn't understand options trading should get into options trading, because I think it's a very risky business. Additionally, I could say that as someone who believes in free markets, I think that if your idea is good enough and you're good enough at executing on it, you can raise VC capital. There are actually private equity funds and venture capital funds that are actively looking to invest. And so if you can't raise money successfully, it must mean that A, your idea is not good enough, or B, they don't trust on your execution. And then I might say that not every business has the right to exist because the free market doesn't think it should exist. And so,
Yeah, I agree with a lot of what you said, but not everything. So no, private market investing, startup investing is not for everyone. But the government shouldn't decide who it is and who it is not for. The government coming in and making the decision about who it's right for and who it's not is not the right choice. But rather, I would never stand in front of you and say that every single person in this room should be investing in startups. You will lose your money. And those that do it for a living will tell you you are going to lose your money because many startups fail. What the difference here is in whether the government makes that decision for you individually or whether you make the decision for yourself. I will also I want to kind of correct or say challenge you on the idea that if your idea is good enough, you will be able to get VC funding. I agree that is true for some ideas, but there are plenty of barriers that have been put in place, both through systems like this, but also kind of structurally in our economies that sometimes make that not true. In the United States, for example, VC funding goes primarily to young white males. It is a long time issue in the US that VCs fund people that look like themselves. And women-led companies, minority-led companies have a very hard time getting VC funding. That's changing a bit over time, but if those people have very good ideas, there's nothing to say that good ideas only exist in the white male community in the United States. We're not giving people a chance if we don't have other alternate ways of them finding funding, either through their communities or through their own connections. And these types of restrictions harm the ability of people to get the leg up, to get to the place where they can grow enough to attract the already difficult to attract attention of the VCs.
It seems to me to go by handout is really important for the emphasize. If you go back to the beginning of the presentation, small businesses will create overwhelming amount of new jobs in the economy. right?
Yeah.
So we have here a picture where small businesses overwhelmingly are the major job machine in the country. Simultaneously with that, we have the reality, starting a small business is very risky. So we have the headline here that risk is intimate with the major source of job creation in the economy. It's an extremely important point. And so we want to be able to let it happen. The risk is a fundamental part of a dynamic economy.
It is, and it's the way that we innovate and grow as well, without taking any risks. The good ideas never have a chance to come to the forefront. You generally don't attract venture capital until you've grown some. You need to give people the opportunity to get that Series A, to make the money, to raise the money, to be able to hire their first 2 employees, where they can attract the attention of the larger funding pools as well. We have to have the risk in order to allow these companies to grow. I'm walking around without that. I'm gonna, I would say, slide relatively quickly through some of these other restrictions because I want to get to the actual ways in which startups are invested in. So there are other restrictions, even though you might not be making the full slate of disclosures that you might be making if you were in a public market. A lot of small startups, when they're trying to raise capital, need to make some disclosures to their investors. That might be in the form of a prospectus. It might be in the form of recurring disclosures after they've raised money. It might be in the form of disclosures that they need to make to the government saying that they have raised money. Well, this generally gets justified as it's better to give people more information about the investment. And I say disclosure is something that often is good. We cannot ignore in these contexts that disclosure can also be very expensive for a small company starting out. A lot of the ways in which these disclosure regimes are designed don't allow an entrepreneur to sit down themselves and write out a disclosure. They have to hire a lawyer. Maybe they have to hire accountants. And that's money that these small businesses don't have already. In fact, they're seeking money to be able to grow their businesses, but they need to have enough money on hand to be able to write the disclosures that allow them to raise the money. And it's very important when we think about the benefits of transparency and the benefits of disclosure to also weigh that against the costs of disclosure and the difficulties that that puts on people in the system. I think an important distinction here in the small offering space, I said public markets are good for raising a lot of money. Small markets may or may not be good for raising a lot of money. Depending on the type of offering raise that you are looking to do, you might be limited. Certain types of funding raises might only allow you to raise up to $1 million. It might only allow you to raise a smaller amount of money than that. These are important considerations for the small business owner who's looking to fund their business. And it's also, I'd say, important when we think about kind of designing a system here because it adds to complexity in terms of your average person being able to understand how they can raise money for their business. If you have a system where there's overlapping types of offerings or types of pathways, depending on the size of the offering that you're raising for, it gets complicated pretty fast. And that can be a barrier to entry for entrepreneurs who are not familiar with raising money. And then finally, there are restrictions often in the private offering space that prohibit people who have invested from reselling their securities. Now, that makes some sense sometimes. The argument for this is that people who have bought into a company know more about that company, and you don't want them selling to someone who hasn't had the opportunity to interact with the founders themselves. It's a more risky sale down the line than it was initially. You're compounding risk. But there's another side to that coin as well, because by not allowing people to resell, you're limiting the ability of an investor to change their mind. You're locking them into a much longer term investment. And you're also long term changing the way that a company looks at its future funding sources, because a lot of times future funding sources decisions are made in order to allow initial funders to exit the opportunity. So we hear these days about companies going public, but in the United States, but not actually wanting to raise money. They just want to be on the public market, so it gives their initial founders the opportunity to get out of the shares and allows new investors to come in. That might be good, that might be bad, but you need to think through whether or not these types of restrictions, the costs and the benefits, make sense.
Also secondary sales.
Yeah, secondary sales can get complicated in the space. And let's say the secondary markets for a lot of private securities are rightfully or wrongfully very thin. Sometimes I think that makes a lot of sense, sometimes I'm not sure that it does. The secondary sales markets in the US are much more developed than elsewhere. But there's been, there's a lot of public policy concerns about one way or another on this. So this, I don't expect you to be able to read this. It's small. It is only there to show you just how complex the US private market system is. These are the many different ways you can raise money outside of a public market in the United States. Many of these have the restrictions that we've been talking about. So while we talk about US having free capitalist markets, this is not a good design of a free capitalist market. This is very restrictive. It limits people's options. And despite the United States having a very active small business culture, this puts a major drag on the ability of small businesses to find the capital that they need to grow. Let me go back here for a second before I pop forward. This has a number of different options. Some of them are conducive to what's known as angel investing, which is typically investing that is done under the guise of this accredited investor standard. It has no limitations on how much money a company can raise, but it has limitations on who they can raise it from. We also have a crowdfunding regime, which has limitations on how much money you can raise, but you can advertise it widely. And there's no limitations on the type of person that you can raise that money from. It's a way to put out information on the internet and to get small investors. Those are two of the more popular ways in the US. Some of these other options here are generally used by companies seeking much larger amounts of money and tend to be more mature companies than when we're talking about just our startup companies. And I feel like I don't need to talk to you about startup companies all that much because this is the startup nation. I'll say what's worth noting here is, that is not, okay. I'll say Israel has similar systems to the United States for crowdfunding and for angel investing. Crowdfunding, as I said, was internet-based finance where you can raise money from any individual, but you can only raise a small amount of money. Israel's crowdfunding system allows small businesses to raise only up to about $1.5 million a year. That sounds like a lot of money, but it doesn't tend to be a lot of money. In fact, the United States had a limitation that was relatively low up until a couple of years ago, and they raised it to $5 million a year because companies were finding that the $1 million a year limitation was too small. I say crowdfunding also comes with the requirement that you have to provide some sorts of disclosures. These disclosures tend to be more minimal than public company disclosures, but it's still, again, a burden. I don't know what the specific disclosures look like in Israel, but in the United States, we've had issues with the types of disclosures being required because they often require small businesses to hire lawyers and accountants to complete them. And when you are seeking to raise a small amount of money, hiring a lawyer or an accountant takes up an awful lot of that money right off the bat. Israel has a very active angel investing network. Compared to the United States, the requirements for being an angel investor, aka an accredited investor or a qualified investor, are much higher in Israel. You must make a lot more money than in the United States. I had the numbers here and I don't have them, but you're nodding your head, so I know you know what the numbers are. But again, it's limiting the population of people. Thanks. It's limiting the population of people who are able to invest in the ideas that they find to be worthy. Israel's got a huge venture capital accessibility, a lot of that money coming in from overseas. But again, all of these things support a very active small business environment and allows for ideas to grow from the seeds into larger companies. I'll say what's distinctive about Israel versus the United States in kind of the small business funding zone is the amount of government support that is available in Israel for small businesses. A very important part of, say, the landscape here for small business funding comes from places like the Israel Innovation Authority, which provides grants and often provides kind of strings-free grants that only have to be repaid if the company is itself successful. That is not something that we have in the United States, although it's something that people in the United States have talked about wanting to have. I think it's a dangerous territory because it's difficult when we're talking about government support to not have the government be picking winners and losers in the ideas. I don't know how successful the Israel Innovation Authority and other entities here are at giving money without making a merits review as to whether or not the company itself is going to be successful or whether or not they think the idea is one worthy of pursuing. Once you start injecting government support, you often end up with a situation where the government is choosing the companies that are worthy, and that itself is problematic in terms of allowing capital to be put to its best use. We don't need to have the government deciding that you can or can't invest in Apple, and we don't want the government to make the decision about whether or not it thinks it's a good government investment. That is what I have. I think we've got a minute if there's another question. Otherwise, I'm happy to be done.